Look at these beautiful numbers. SPY almost 2% down, Roku down 10%, Wafer down 8%. I did a put spread on the Qs, and now my spreads that I opened yesterday are close to getting tested. Dash, Fiverr, and Square are completely breached. Dash, I have a 150, 145 put spread. It's trading at 127 for January 21st. Fiverr, I've got a 115, 110, and it's trading at 95. So I'm going to start selling call spreads. I think I'm going to just have to. I don't think it's going to come back up by January 21st above my short strike. It doesn't look too good. So I'm going to start selling call spreads against Dash, against Fiverr, and against Square, and I'm going to turn it into an iron butterfly. So for example, if we take Dash or DoorDash, see, I've got a put at 150, 145. Now I'm going to sell a call spread against it, turning it into an iron butterfly, making sure the short strike doesn't surpass the short put. Therefore, there's no risk, there's no added risk. My max loss is still the same. It's going to be $5 minus the credit received from both the put spread and the call spread. And I'll have, I'm basically just reducing my max loss. But my profit zone will be between 145 and 155. So for example, to sell a call spread, just gonna change the put to a call for both, and it changed it automatically for both legs. I'm gonna click on sell. I've got the 150 call, and then I'm gonna pick a long call that's 5 points away. So basically I have the same width of the strike. Wow, that's sad. That only gives me not even 20 cents. Wow, definitely should have sold that call spread earlier or sooner. So I'm not gonna do that. It's not worth selling a call spread for a few pennies. So another thing I could do is I could probably sell it for February and then roll the put to February, but then I'll see how much I have to pay to roll it to February. So if I sell a call spread for February, I'm gonna collect about 70 cents. But if I close DoorDash now, I have to close it for about $4 and I'd be losing $3. So I actually have, there's nothing I could do. I'm not gonna sell a call spread. I'm not gonna roll it to February. All I could do is hold on to it to January 21st and see what happens. Either I take the loss on January 21st or I roll it super far to January 2024 and add a contract. So like I showed in the previous video, I could roll it to January 2024. Maybe take like 130, 125 and add a contract. And this way I could do it for a small credit and I don't have to worry about it right now. Or I could roll it naked. DoorDash, if I'm comfortable with DoorDash, I could roll it naked. Obviously not January, I could roll it to maybe February. If I roll it to 110 or even 115, I could do it for a small credit. The 115 put for a small credit. So that's one possibility. I'll decide January 21st. I'll do the same thing with Fiverr and Square. Now the problem is I open a new trade, triple Qs, 375, 370. So this is part of the Monday, Wednesday, Friday strategy that I like to play on the index. But it wasn't the best entry. I sent the order for $1 initially. I changed it to 90 cents so that it could get filled. It got filled later, but it's actually worth $1.20. So I definitely didn't get the best entry. 30 cents, the max that I could have gotten. And I'm just thinking, what would be the way to manage it if it gets breached? If 375 gets breached, which is only 9 points away, do I manage it with a call spread? I think I'm gonna manage it with a call spread sooner. Not like DoorDash and Etsy where I waited too long. But I think if it gets tested, I'm gonna manage it with a call spread. But I'm gonna be selling another one if triple Qs drop to 375, then VIX will be higher and I'll be able to sell a new put spread at a much better strike, new expiry as well, 28 days. So from Monday to Monday, Wednesday to Wednesday, Friday to Friday, always 4 weeks away, giving me 28 days expiry. Shopify, the trade that I did yesterday, It went up because it dropped a lot, but it looks like it's still worth about maybe 250 maybe. But yeah, it wasn't the best entry yesterday, so it's still a good entry. And Adobe wasn't good at all because, as you can see, it's worth about $2 right now. Adobe dropped to 515, so I'm only 10 points away. But if it drops below 505, I'm definitely going to sell another put spread on Adobe for the same expiry. If it drops anytime soon, below 505, it's worth selling another put spread for February 18. And this new put spread will probably be at 470 maybe. And then I would manage this one with a call spread. I would start off with an out of the money call spread first, but worst case scenario, I bring it in as an iron butterfly. So I would do a call spread at 505, 510. But I would do that if Adobe falls further away. I'm just disappointed I can't get anything from the call spread. Let's try Fiverr here. If I try to sell the call spread, 115, 120 for January 21st, pennies as well. Just because Fiverr dropped a lot and I only have 16 days to expiry. And if I go to February, I can collect $1, but closing Fiverr is gonna cost me about $4. So it's not even, I can't even compensate the loss on the put spread with a new call spread. Actually, I'm gonna still have to roll the put spread. So let's see if I roll the put spread from January to February. So 115, 110. So if I roll it to February as is, I'm gonna have to pay a debit for sure. So I'm gonna pay a small debit of about 50 cents maybe, but then I can go collect $1 from the call spread in February. So that means I rolled for a net credit of 50 cents. So now I'm gonna have an iron butterfly in February that I collected a total credit of $1.50. And my max loss would be $3.50. So let's try DoorDash again. I forgot that I'm gonna be rolling it as a put spread, so it's gonna cost me less to roll because I'm gonna be selling a new put spread in February, same expiries. So 150, 145, February 18. So that's gonna cost me, okay, so I can roll it for break even, but that's probably not accurate because market is closed. But then I can go collect a $1 from the call spread in February, 150, 155. Actually, it'll be about 70 cents for the call spread. Now, that's about 40 days away, 44 days away. Can that DoorDash go up 150 divided by 127? Can it go up 18% in 44 days? I don't think so. I think it's unlikely. 18% in 44 days. And Square, what about Square? Let's see how I'm gonna manage this one. So let's say I roll it as is to February 18. So 160, 155, February 18, 155. That'll give me, I'll have to pay about 45 cents for that one. And now the new call spread in February would give me, if I turn it into an iron butterfly by selling a 160, 165 call spread, 160, 165, that would pay me about $1. So yeah, so that's a net credit of 60 cents. So I'd have an iron butterfly in February 18, for February 18, total credit of about $1.60. Max loss of $3.40, and I still have a chance of winning, a smaller chance, but I still have a chance of winning if Square stays near 150, 160 by February 18, it's going to be very hard to pinpoint it. Another thing I could do is add a contract to February, but I'm not sure I want to do that. Because what if it doesn't go up by February? Then I've just added risk. If I roll it to February right now, add another long leg here for the put spread, so 140, 135, let's say, but I'm gonna do 2 contracts for February. See, I can't even roll for a credit that way. It'll be for a small debit. So I'm adding risk and I'm not even rolling for a credit, but what if I go to March? If I go to March, will that give me a credit? Yeah, that'll give me a small credit. So I could do that instead of selling a call spread if I think Square will eventually come back up If I'm not comfortable with March, then I would just throw it to January 2024, 140, 135, and that way I'm getting a credit, but I'm also extending it to January 2024 to give myself the best chance that eventually Square will be above 140, and I don't. This way, I don't confirm the loss. It's a hard decision to make because if I want to be mechanical, then I should sell a call spread, take the loss, and move on. But by constantly rolling, I end up carrying a lot of unrealized loss, and that's the position that I'm in. I've got a lot of positions that I'm just holding and waiting for them to recover, but it becomes a little bit annoying and stressful. So you have to choose between taking the loss and being stress free, or keep rolling and waiting for the stock to recover, but then it becomes a little bit more stressful watching these positions always in red. Now, let's see if there's anything green today. If there was anything green, there was only Baba that was green today. But as you can see, everything was down today. Even Tesla was down 5%. Roku down almost 11%. Let's see after hours what the triple Qs is doing. So after hours, it's up a little bit, but doesn't mean anything. Tomorrow could be down even more. Hey, we've got a 52-week low of 297. We haven't seen that in a while. Is the next support at 350? Will the triple Qs hit 350? Alright, so just want to share with you my new trade on the triple Qs and how I think I will manage my breached put spreads. So a few possible ways: either rolling it with a call spread to February, either waiting till expiry and then just rolling it to January 2024 with an extra contract, or rolling it naked. Naked might be easier, but then there's a risk. What if it continues to drop even more? It's taking a lot of buying power out of me. Roku alone is taking a lot of buying power out of me. I was at almost 42 available buying power. Now I'm at 37. All right, thanks for watching.